Good evening. This is Ken Long from Tortoise Capital Management with a review of the weekend reports for April 9th, 2011. Looking at page 1 of the weekly. We're in bullish normal conditions. On an annual basis, we're slightly above average on a weekly RSI. On the 10-day index, we're at 68, so we're at the slightly above average again on overbought conditions. The percent stretch above the 200-day moving average has pulled back to 11.26%, which is still bullish, but puts us back into the white condition code from out of the green. Last week, you recall, we had moved back up into green. We're now back in white. Slope of the 50-day moving average hasn't changed much since last week at 0.35, although that was just enough to move us back into the red from a yellow condition, and that's bearish. The ADX 14 has come all the way back below 15 at 14.7. That's a weak or untrending market. That's also a location from which a next trend could emerge that could last 4 to 6 weeks in SPY. ATR percentage is back under 1 at 0.85%. That puts us at the low range of normal. So the market's in bull normal conditions and neutral on a short-term basis. The equities have pulled back from the test of the previous swing high. The previous swing high in SPY was up around 135. It's pulled back slightly from that after clawing its way back up from a 10% pullback. The Qs have been especially weak among the U.S. indexes. Meanwhile, strength is in and continues to be in precious metals, commodities, any kind of energy, especially silver leading the way. Monthly rebalancing, no change. On the market health check, you can see how much ADX has declined. We're looking at the 10, 20, and 30-day look-back periods on the vertical blue lines. The horizontal purple line is the previous swing high at 135. You can see that that has acted as a resistance level for the last 1, 2, 3, 4, 5, 6 days. The black line in the middle is the slope of the 30-day regression line. The outer black lines are a channel formed by the maximum excursion from that regression line during the look-back period. Green line is a 10-day moving average, so price is slightly above the 10-day moving average, which is better than the 50, which is better than the 200. That's long-term bullish, but on a short-term basis, we're looking at continued weakness here as it has failed to pull above 135. The two red boxes represent 5 and then a 10% pullback from the previous swing high, which is back at the around February 22nd. It's come all the way back up, but it has failed to go further. The market just came out of overbought conditions on the Williams percent R on a 10-day look back, and then on a annual look back, you can see that we're still well overbought. Summary of the ETF2 database, the 10 important regions. 8 of the 10 are positive on the 5-week rate of return, which brings our theoretical model up to 80% invested, 20% cash. You can see that the weakest one is Japan by far, and strength is in emerging markets and Asia less Japan. And U.S. mid-caps are the strongest of the U.S. sectors. So the U.S. mid-caps, followed by the small caps, followed by large caps, followed by technology within the U.S. On a global basis, SPY is doing better than EFA. Strongest two sectors, again, Asia less Japan and emerging markets. Weakest, Japan and U.S. technology. World market model, you can see once again the strength in the precious metals and commodity sectors. Treasuries and corporate bonds are suffering. Japan still is the bottom of the barrel. Inside the U.S., you can see mid caps are slightly better than small caps, which are better than large caps. Emerging markets, Australia, South Korea, Asia less Japan, Sweden, Germany, and Spain represent the extremely outperforming sectors right now. Energy remains above average. Global materials made a little move this week, but otherwise the strength in commodities is so great that conventional business operations right now, or business sectors, are just suffering. 100 by 200 crossover system. Again, this is just measuring the general health of the market. You can see everything has rebounded nicely these past 2 weeks and are now up on a buy condition. Only a few selected defensive sectors, plus Japan, are suffering. The top 30 ETFs in the ETF2 database, once again, like the last 2 to 3 months, has been dominated by energy, any type of commodity, precious metals especially. You can see oil is well represented inside the top 30 as well. Just a quick reference of the top 30 ETFs by daily dollar volume. So these are going to be the most liquid ones. Those that are highlighted in green are exceptionally volatile intraday. You can see the VIX ETF, symbol VXX, has pulled back to 3.52% ATR percentage. Just last week and the week before that was up well over 6. So the volatility and fear in the market has been cut in half as it has pulled out of this 10% correction. So the market's starting to look complacent. And that represents the daily, the weekend report context. And precious metals, energy, commodities of any type. The emerging markets are the growth story. And continued fear about Japan and Middle East seems to be driving up oil prices and is rewarding energy companies. So that's review of the weekly report from Ken Long at Tortoise Capital. We'll see you on the high ground.